Hello, welcome to Economics 101, your number one source for everything economics. What if I told you the United States is now over $36 trillion in debt? And the most dangerous part isn't the actual number, it's how fast we're spiraling out of control. In 2026, the risk of real debt driven financial crisis is no longer just a theory. It's actually being discussed by economists, investors, as well as policymakers. In this video, we're going to break down why the US debt is exploding right now, how rising interest rates uh, made things worse, and what happens to the system if we start to see some cracks. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple breakdowns of complex economic topics, consider subscribing and hitting the like button so more people can see this type of content. Let's hop into it. $36 trillion dollars in debt. As of 2026, the US national debt has crossed over 36 trillion. To put that in perspective, that's more than 100% of the US GDP. Now, debt itself isn't new. That's not a new thing to the US. The US has been running deficits for decades. But here's the shift debt is no longer just growing, it's accelerating. Annual deficits are still running above 1.5, $2 trillion a year, even, even outside of a recession. Okay. And that's a major red flag because historically governments spend heavily during crisis. But right now, this is happening during a relatively stable economy. So the question becomes if this is the baseline, what happens in the next downturn? What do we do? So why is the debt exploding? There are three main drivers behind this surge. Okay, first you got government spending. Programs like your Social Security, Medicare, and defense spending continue to expand. Second, higher interest rates. We'll get into that in a second, but this is a big part. Interest rates. Third is the low relative tax revenue growth compared to the spending. Put simply, the government is spending way more money than it's bringing in. And unlike household, the U.S. can't just tighten up its budget easily. Cutting spending is politically difficult. Raising taxes is unpopular. So the default solution, borrow more, basically. All right. Interest payments are a real threat. I'm gonna break down interest rates real quick. Here's where things get a little dangerous. The U.S. isn't just paying off debt; it's paying interest on the debt. In 2026, interest payments are exploding. We're now looking at $1 trillion per year just in interest payments. That's more than the entire defense budget, Medicare spending. Think about it. Think about that. The government is spending more on interest than on core services. Okay. Now, why is this happening? Because the Federal Reserve raised interest rates aggressively to fight inflation. So now new debt and even rolled over debt is much more expensive. It's like having a credit card where your interest rate suddenly jumps from 2% to 5% plus. All right. Uh, Now multiply that across trillions of dollars. Quick pause, guys. If you want more breakdowns like this that connect the dots between the economy, markets, and the everyday life, make sure you subscribe so you don't miss out on what's coming next. Let's hop back into it. Let's talk a little bit about the Federal Reserve role in all of this. So the Fed is in a tight spot. On one hand, they need to keep interest rates high enough to control inflation. On the other hand, higher rates are making the debt crisis worse. This creates a policy trap. If the Fed cuts rates too soon, inflation could come back roaring back. Could come back. If they keep rates too high, government interest costs keep exploding. Okay, there's no easy way out of this, and markets are watching this very closely. Okay, what this means. Let's talk about what it means for the average person, myself and you. All right, this isn't just a government problem, right? It's difficult. It directly affects your life, my life, and basically how that happens is we see it mortgage rates. Mortgage rates stay higher because treasury yields influence borrowing costs. Stock market volatility increases. Higher rates reduce company valuation. Inflation risks remain. If the Fed pivots too early, taxes could rise in the future to stabilize long debt, and possibly the biggest one is economic slowdown, risk and increase because eventually something has to give. Okay, so the big question on all of this, or the breakdown, when you look at the bigger picture, is this a manageable situation? All right. Or are we watching the early stages of a real debt crisis? If you made it this far, please drop a comment below. Do you think the US can handle its debt? Or is a crisis inevitable? And if you found this breakdown helpful, make sure to like the video, subscribe for more content that simplifies the economy without the noise. Okay. This channel is all about helping you understand what's really happening behind the headlines. Remember, this is Economics 101, and I will see you on the next video. Thank you.